Hi, welcome. This is Mary Ellen McGonagle with your Daily 5 for Thursday, May 13th. For those of you not familiar, I am the founder of MEM Investment Research, and prior to that, I worked not only on Wall Street, but with Wall Street for over 15 years, a VP at William O'Neill and Company, where I worked with top portfolio managers and analysts, advising them not only on the broader markets, but also on individual stock selection. And with my 5 years at MEM Investment Research, I'm proud to be sharing my many years of experience with self-directed investors. And with that, I'm the author of a top performing newsletter, MEM Edge Report. You can access a 4-week trial at a nominal fee by going to my website, meminvestmentresearch.com. Let's get started today. I'm going to be talking with you about how you can chart your course during this rather tough period that we've experienced, certainly over this week and even going back over the prior 3 weeks, a lot of back and fill, really go nowhere type of environment. And in essence, I'm going to be sharing with you this concept that history does repeat itself, and the fact that you can use historical precedents to help guide your investing during this difficult period. So let's go ahead by starting taking a look at the current market conditions. What is the backdrop? Well, certainly to begin, yesterday on Wednesday, we did get core consumer price index was reported. The number was very, very high, well above analyst estimates. In fact, month over month, the number reached levels not reached until back in 1981. So certainly we're in a period of inflation with this consumer price index increasing rather dramatically. Earlier in the week, we did get information regarding U.S. job openings, and this number actually spiked to a record level as the U.S. economy is continuing to reopen. We're seeing that there are not enough workers to fill those open positions. This is another strong signal that inflation rates are rising, as these unfilled job openings are going to put upward pressure on wages, which in turn will increase prices and then subsequently inflation. So let's take a look week to date how the markets are responding. We're taking a look at several major market indices, and we can see that volatility has spiked. It has gone up rather dramatically, 33.5%, currently at a level in the mid-20s. Not good, certainly for near-term prospects, but it is just in the beginning potential stages of increasing as fear due to these higher inflation levels is beginning to penetrate the markets. Also, in response, we're seeing an uptick in the yield for the 10-year Treasury. It is now currently at 1.69, and higher interest rates also are a deterrent to an upside to the broader markets and also a byproduct of inflation. From there, let's take a look at areas this week that have been hit the hardest, and we can see certainly within technology, semiconductor stocks are down over 6%. Small cap stocks also down almost 5%. The decline in tech stocks, as evidenced with the semiconductor and also software stocks down over 3%, is impacting the NASDAQ, which has entered into a downtrend with its price break below its 50-day simple moving average. And in addition, even the cyclical, or rather value-oriented Dow Jones Industrial Index is not unscathed, down for the week. Moving on, taking an even broader overview look, I wanted to share with you some areas this week, given the high inflation numbers, that are generally bucking the market's downtrend. And what we can see here immediately is silver, oil, gold, copper, a lot of commodity-related areas are managing to withstand those downward pressures. We'll get more into that as we move on. But I did want to share with you here some prior inflationary periods. I talked about using history as your guide, taking a look at precedents. First up, we can take a look at 2005. That had an inflation rate of 4.25%, well above average. Also, 2006, 2.5%, only nominally above that 2% range that certainly the Fed is targeting at this current period. And then in 2007, we did get another uptick as we entered that period with the bank crisis. Inflation did get up to 4.25%, so higher than average inflationary periods that we can view, again, for historical precedent. I did want to go ahead from here and share with you a study that came from the offices of Ned Davis. He's a well-known economist. And in essence, his study showed that energy stocks have the best track record during periods of rising consumer prices, which in turn, of course, is leading to inflation. In fact, 7 out of the 9 cases of high inflation since 1972, energy stocks outperformed the S&P 500 by a median of 14 percentage points. So certainly worth noting as we look at history for our guide. So from here, I did want to go ahead and share some stocks from that 2005, 6, and 7 period where we discussed elevated inflationary rates. First up here is a monthly chart of Chevron. CVX is the ticker symbol. And we can see from this 05 period up into and beyond 07, Chevron, an oil and gas major integrated stock, did in fact enjoy a very nice uptrend. Another stock that we can go ahead and use as historical precedent is another large integrated gas company, and this is oil related, of course, ExxonMobil, XOM, again going back to that 2005 and 2008, we can see the stock was in a very significant uptrend. One last name in the energy space that we can take a quick look at here is Devon Energy, DVN, and again, a nice uptrending period that extended even beyond that 07 high inflationary period. Another name that actually outperformed, and not surprisingly outside of energy, is U.S. Steel. And we can go back to that 2005 into 2007 period. And this is in line with that concept that commodity stocks that we viewed when we were looking at those industry groups do have a predisposition to outperform during periods of high inflation. Let's take a look at one last name just to emphasize that 05 to 07 period, that not all stocks performed well. This is Macy's. It did have a little bit of a run up, but certainly fell out of bed going into 07 into 08 as an example. From here, I do want to go ahead and share with you an example of a current chart of a stock that is poised to potentially outperform should the increase in inflation continue. This is a daily price chart of Devon, DVN. Of course, we saw it outperform going back in the 2005-07 period. And what I'm pointing out to you here is the stock emerging out of this space back in November. The stock was added to my MEM Edge report back here as it emerged from this lengthy downtrend, breaking back above key areas of resistance with your outside momentum indicators turning positive. And from there, the stock has remained on our suggested holdings list throughout that period. We were advising to stay with the stock during this pullback, get back in during this resumed uptrend, and so forth. At this point in time, DVN is now poised to break out of a multi-month base, and should we see that occur on volume, we could very well increase and extend the recent uptrend that Devon has been in. This stock has been an over 100% gainer for subscribers to my report, but more importantly, in line with other high-quality energy stocks, Devon is holding up remarkably well in an otherwise difficult period. And as history will tell us, oil and other commodity-related stocks do outperform during periods of inflation. That's it for today, and I want to thank you for watching your Daily 5.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're going to bring you daily content from an incredible collection of technical analysts and financial experts.